ado, Punam. Thank you. You know, it's interesting to do the 2015 outlook because I wrote this, I guess about a month ago. It's amazing how much is already wrong. Really set some up. So anyway, we're gonna have to do a little bit of adjusting, but not too much. I have to remember that our disclosure is that we do not give investment advice. Just remember that I'm free, and so if you hear investment advice, you've got the values properly set up. Let's start with China. I'm going to do the U.S. last because today was such a weird day. I mean, when I heard those Apple earnings coming out, I said, how did they sell 75 million phones? Well, they sold a lot of them in China, and China likes the bigger, the 6 Plus version. So China's a big part of Apple's strategy. And I mention Apple in terms of this because a lot of people are really concerned about China, that it's slowing down, it's decelerating growth. It's almost like people think it's in recession. China grew 10% a year for 30 years, so it's not doing that anymore. Okay, it grew at 7.5%, 7.4% last year. I wouldn't get too fine with the Chinese data numbers. That's why I do my forecasts in decades. I'll be retired by the time you figure out this won't be right. But we do think they're slowing down. And they're slowing down for a couple of reasons. It's just another plot of the graph to show you the deceleration. I do want to point out the numbers. They're still above 6% growth in 2015. For a big economy like that, that's a lot of global GDP coming into the marketplace. So let's not get too pessimistic about China. The interesting thing to know about China is the urban employment is growing at about 3% a year, but total employment's not growing. Now, that's really what's happened when you have 30 or 40 years of a one-child policy. You stop your population growth, and so the growth that's happening to their labor force is really all about a migration. And what people are doing is they're migrating from the rural side to the urban side. And they've come in now, it's about 50-50 employment now. There's about 50% of the workforce is employed in the rural sector and 50% in the industrial sector. Once they get up towards 70% of it being urban, it's going to slow down a lot. So this labor force growth that they're getting in the industrial sector has only got about 5 more years to go at the current pace. Let me back up now. I want to say so if you think about it, like if you were a retail sales analyst in the United States, you'd do something called same-store sales. Now, what a same-store sales is, you take last year's industrial employment and you figure out how much GDP they created. And I put that between 3 and 4%. Okay, and then you take the new people. Now, this urban migration, I don't know if you got the sense of it here, but we're talking about 15 or 16 million people moving every year. This is a big country. So we're going to build one new sprawling Chicago every year, plus maybe a few other cities. That's worth a couple of % of GDP every year. So that's the additional new store sales that they're getting. That's the piece they're going to lose over the next 5 years. So then when you get to the 2020s, they're going to be a slower growing economy. The other issue they have is aging. Again, when you go to the one-child policy and people live longer and they don't have as many kids, the average age of the economy moves up. And in the 2020s, 20% of their population is going to be over 60. That's a pretty big percent. It's not as big as Japan or Korea. It's not Germany, but it's a rapidly aging situation for them. Now, several things happen when you age. It's not all bad, but you tend not to be quite as fashion forward, and you don't buy that new pair of shoes every year necessarily, or and about the only thing you spend more money on is maybe health care. But per capita consumption goes down when you have an aging population, and so China's trying to become a more consumer demand country. It's not going to happen very easily. The other thing that happens in China is they don't have a very good Social Security network. Well, actually, they have a very good one, but it's not provided by the government. The one they have is provided by families. And so family savings are really what's going on here. And so that makes it even more difficult for them to shift over to a consumer-led economy. But the message really on China, I keep turning this thing around. Okay, there we go. Is they're still growing. One of the ways they stimulate their economy is with new loan growth. And basically, they operate quite differently than the Federal Reserve or the ECB. They just call up the banks and tell them to lend money. And so it goes out, and you can see this pattern of higher loan growth. That's how they're keeping the economy going. Even as they slow down a little, they're kind of providing a buffer. One of the other effects of the economy is they've had some currency strength. Now, this is a very long picture of the currency from 1981. The currency was extremely weak from 81 till the mid-90s, and then they fixed it. That's that flat part there. And then as the line goes down, that's actually a stronger RMB. They started allowing the currency to strengthen. Now, this is a picture just from June 2012. And from June 2012, what you can see is that the currency has started to weaken a little bit, going back up. The line going up is a weaker currency. And the implication for that is a couple of things. One, they're not having to manage their currency very much anymore. And when they don't manage their currency, they don't have to buy U.S. Treasuries. This is a graph of the Chinese accumulation of U.S. Treasuries. So when their currency was strong and they wanted to keep it from being even stronger, they would buy lots of U.S. Treasuries. In the last year and a half, they haven't had to do that anymore. So if you floated the currency, it wouldn't sink, but it wouldn't go up either. It's relatively balanced these days. What I interpret that to mean is they have a nice window of time here if they want to normalize their economy and integrate it more with the rest of the world, they can do it faster. Because if, like 10 years ago, if they had floated their currency, it had gone up 40% right away, and that would have screwed up all their industry, and a lot of different things would have happened that wouldn't have necessarily been good. Now, if they float the currency, normalize it, make it more convertible, there'll be almost no impact on their economy except maybe a positive impact of giving their citizens a little more voice in the global economy. So anyway, that's the China story. Japan, another population story. This is Japanese GDP growth over the last 30 or 50 years. In the 60s and early 70s, they were an 8% GDP country. Then they became a 4% GDP country, and now they're like a 1% GDP growth country. It's not that dissimilar from the China pattern, it's just 20 years ahead. So you want to think about that. This is where their real GDP has been bouncing around. We think that they're about a 1.5–2% economy. Now, the reason for that is the same reason as for China slowing down in the 2020s. Japan has no population growth, no labor force growth, but it's a very modern economy. So the only way they're going to get higher growth is they get higher labor productivity growth. Now, if you do the arithmetic of GDP, if I say that the country's growing at 4%, part of that comes from more people working, and the other part is just the math of it. They must be more productive. Without more people working, it's got to all come from greater productivity. You can do that with better technology. You can do it with capital investment. You can organize your labor force better, but it's really hard to get more than about 1.5 or 2% growth out of a country that doesn't have labor force growth. They've been worried about inflation for 20 or 30 years, ever since they pricked their bubble in the late 1980s. And they haven't had any inflation. They talk about deflation, but they've only just had, it's been trending just below zero, minus 1%, something like that. More recently, they've had a little bit of inflation, but that's because the government raised the national sales tax. So that's a sales tax rise that gave them inflation, not something that's really happening. And that'll go away in 1 year. When you do the year-over-year comparisons, it'll be gone. So they want to, and their theory is that when there's no inflation or deflation, people put off purchases because they're not worried about, the price going up, so they don't buy it. So when they were worried about the price going up, with the sales tax increase, people actually really did buy a lot more stuff. They had like a plus 6%, 7% GDP quarter, and then the next quarter it was minus 6 or 7%. So, I mean, they got it and then they gave it away. What they really are doing to create more inflation is buying their government bonds. This is the Bank of Japan's balance sheet, and it's headed toward the sky there. That's all their purchases of Japanese government bonds. That's the light blue is government bonds. That's what they're buying. And when they first started doing this in April of 2013, some of us, and I was in this camp, thought, well, eventually, if they ever do create some inflation, this is probably not good for government bonds because higher inflation would take yields up. But you have to remember, when you're buying Japanese government bonds or selling them, because there were some market participants that wanted to sell them thinking that, more inflation was going to mean higher yields, you got to remember that they're buying 30, 40 billion of these things pretty regularly. You really shouldn't sell these things until they stop buying, because they can buy as many as they want and just print it out. So government bond yields, instead of going up above 1%, their 10-year bond yield is below 0.5%, so no yield there. What they have succeeded in doing is weakening the currency. Yeah, that's really right. The Japanese yen, this is going way back to the 70s, but they started the 60s at 360 yen to the dollar. Now they're at 120, but they went down to a low of around 78, 80. So they had a history of a very, very strong currency, and they're trying to reverse that. And that's their main weapon to get their economy moving and get a little more inflation. And you might ask, what do the other central banks think of this policy? We've been highly critical of China's policy of managing its currency, and we never say anything about Japan. The deal was that as long as Japan only bought their own debt, the U.S. and other governments wouldn't say anything bad about it. China, of course, buys our debt. So that's the distinction they made. But what really matters from a central bank point of view is if you're buying anything, you're putting your currency out there and you can weaken it that way. So their whole policy is weakening the yen. One thing about yen weakness is very correlated with the stock market. When the stock market has a bad day around the world, Japanese, like many other sets of investors, bring their money home. Money feels safer at home, even if it's not safe. If my portfolio is going to hell in a handbasket, I just bring it back. Let's go to cash. Let's go to dollars. What the Japanese will do the same thing. They'll bring it back from overseas, and so you get a little bit of yen strength on days that you have really bad equity market days. The other thing that goes on is when the yen gets really weak, it's not about exports. Japanese companies have huge overseas holdings. They have plant, they have equipment, they have security. So when the Japanese yen goes down, the yen value of all those non-Japanese things gets valued upward. And the Japanese stock market in yen terms reflects that. So my only warning to you here is if you decide you love the Japanese stock market, you might want to hedge the market, hedge it in yen terms. Buy the stocks, sell the currency at the same time, because otherwise it's not going to be quite as happy as you might have been thinking it was. There's also, I put this chart in just for kicks. This is the history of the Japanese Dow Nikkei against the U.S. Dow Jones, going all the way back to 1970. And they started almost in the same place, and now they're almost in the same place. But boy, different path. Europe. We actually think Europe might grow next year. They've had a couple of years of stagnation with their sovereign debt crisis and so forth. And they don't have any inflation either. They're very worried about deflation. So let's take a look at what the central bank is doing. This is the European Central Bank. Now, what they mainly have been doing is making loans. That's the shaded blue area. Right after the crisis and the beginning of the sovereign debt crisis, they provided liquidity loans to banks. But you notice that this central bank balance sheet has been shrinking. The Fed's been growing, but it stopped QE, but it had been growing. Bank of Japan's been growing. These guys actually shrunk their balance sheet last year, and this is an underappreciated problem for their economy. You remember they did stress tests for their banks last year? So they had these bank stress tests. Now pretend you're a European banker, or pretend you're in the 3rd grade, and your teacher says, I'm going to give you a stress test. Okay? And you're thinking, how do I pass this test? And so you're looking at your bank balance sheet and you're thinking, $100 billion emergency liquidity loan. I'm thinking that doesn't look too good on my balance sheet. So they paid it back. So the banks paid back their loans because they wanted to look better for the stress tests. Now when they paid back their loans, what does that mean they're doing? They're not making loans to the economy. The credit system in Europe was basically broken last year. Now, the teacher threatened to flunk a few people, but in fact all the big banks passed. Some of them passed with what we used to call a gentleman's C. Our compliance department edited that out of one of our recent research papers. I'm not quite sure why gentleman's C is not allowed to be CME compliant, but anyway, I've learned not to complain. So anyway, the stress tests are gone, everybody passed, the credit system is going to work a whole lot better. And this balance sheet is going to get a lot bigger because they told us about a week or so ago that they're going to embrace quantitative easing, but they're going to do it their way. Now, the charter of the European Central Bank specifically forbids them from financing government deficits. This is a German thing. They're not supposed to finance government deficits. So they took a page out of Ben Bernanke's Federal Reserve Handbook. You may remember back in September 2008, we had this financial crisis and the Fed, there was this messy bailout of Lehman Brothers and AIG, and the Fed, you know, if you read the newspapers, it said they bought a lot of those assets. That's not exactly what they do. You know, when you start a hedge fund, what's the first thing you do when you start a hedge fund? You look out the window, you spot the street sign, you say, I think we'll call this Maiden Lane. Maiden Lane is the street behind the New York Fed. So they created 3 hedge funds, Maiden Lane 1, 2, and 3, and since the Fed wasn't supposed to buy these assets, they lent the money to the hedge funds, and the hedge funds bought the assets. By the way, the Fed doesn't call them hedge funds. They call them special purpose vehicles. But, you know, that's what they did. Now, what the European Central Bank is doing, and it took them about 18 months to sell all that stuff and get rid of it and unwind it, so they don't have that anymore. What the European Central Bank is going to do is lend money to all the local central banks. So the Banque de France is going to get money, the Bundesbank, if they want it, they probably won't take it. Bank of Spain is going to get it, they're going to take it. And they're supposed to buy their own debt. So Spain will buy Spanish debt, Italy will buy Italian debt, and so forth. And that will hopefully, you know. So that's how they're going to grow their balance sheet. So what will happen is they're going to make a lot more loans, but those loans will eventually get spent on government debt. Now, what will that do? The additional government debt means that bond yields are going to be lower in Europe than they otherwise would be, and they're already pretty low. Now, if you're a global investor and you see, you know, a very low, almost zero bond yield on German bonds, maybe just a little higher on French bonds, even Spanish and Italian bonds can be like the same as ours or something. You know, you're going to go searching for yield around the world, and what you're going to find is United States Treasuries, even at what's the 10-year today, 1.73%, it's going to look like a high-yield bond. So quantitative easing in Europe and Japan is going to cause our bond market to be lower than it otherwise would be, lower yields than it otherwise would be. So that'll be, and we've already seen that impact come into the market. The other thing, out of their own sovereign bond markets, because they'll be buying regularly. And it's just like Japan. If they're telling you they're going to buy every month, you really don't want to challenge them because they got more money than you do. So the implication is here is that the euro is going to get weaker. So the euro is the loser here from this policy. Now the interesting thing is whether or not it makes the economy grow faster. And I don't think so. My view is that an economy only grows faster when there's more spending. And I mean spending on stuff, goods, services, things, not government bonds. If they buy government bonds from, like say that they give money, they lend money to the Bank of France buys French government bonds, does the French government spend one more euro than they were otherwise planning to spend? Now, if you ask the Germans that, the Germans will tell you, sure, they're going to spend more. Fiscal discipline will be gone. But that's not so clear. But anyway, the point I'm making is that if the quantitative easing doesn't lead to more fiscal expenditures, you're not going to have any real stimulus going into the economy. So I think the impact of their quantitative easing on the economy is pretty small. I'm optimistic that they may grow about 1%, 1.5% this year, but that's because the stress tests are behind us and I think their credit system will function better. And they will probably get a little more inflation about in the second half of the year just because they're going to have a weaker currency. So that's the Europe story. A couple of emerging markets. I kind of like India. They have a new government. They're making some interesting reforms. You know, they have a pretty, you know, as bureaucracies go, they're pretty, you know, in the league tables. So they've got a lot of improvements they can make. They're making some of them. They could be a 4 or 5% GDP growth country very easily. This is a chart of their interest rates are in black. Their short-term rates. They can cut these a little further. I think their inflation rate's going to come down. That's partly an oil story, but you know they're a good country to take a look at, particularly on an emerging market currency basis. The rupee, when the line's going up, the currency's going down, but I think it's the worst is done and it's going to improve from here would be my guess. Brazil's an interesting country. This is Brazil's inflation rate against its rates. It's got interest rates 10, 11%. I don't know how many of you are foreign exchange traders, but you know, you take your 10, 11% from Brazil, you take your 0 from somewhere else like Japan, you earn the futures premium is based on that interest rate differential, so you're making 10% a year if the currency goes nowhere. Now, that's a enormous if. So that's the currency carry trade. But if you believe that the Japanese and the Europeans want to get a weaker currency, and you've got a very, very strong stomach for risk, then buying these higher yield currencies makes sense only if you think these countries are on the upward growth path. And I do think India is, I do think Brazil is, but Brazil's a little trickier than India. Brazil has an interesting problem. I think they have the largest freshwater resources in the world, or at least number 2. But they have this enormous drought in Sao Paulo. The rain just comes in over the Amazon and it doesn't rain right around those reservoirs, or it hasn't for the last couple of years. So I gave this speech in October down in Brazil, and I was talking about, I was saying, you guys are going to not be able to take a shower after the election because the first thing the new president is going to do is have water rationing. It started raining the next day. So they have had some rain, but the reservoirs in Sao Paulo, the big one is like 5% of capacity, maybe moving towards 7 or 8 with the recent rains. Some other ones are at 20% of capacity. So the wild card in Brazil is actually something we economists don't watch very often is this drought going to get worse? Because Sao Paulo is a huge industrial area, and if they have to go to severe water rationing, it's just not going to be good. But they are getting a little more rain. So they're a country that could surprise us in 2015. Let's go to the U.S. Finish up here. Got to, all about these guys. My forecast for the U.S. is we're going to have a 3% economy this year. I've been saying this for the last 3 years. It hasn't happened. What I have gotten right is, is I said that the unemployment rate would get down into the 5% territory and be below 6% by the end of last year. It was. So I got the labor markets right, but not the economy completely. And the main reason I didn't get the economy right last year was I did not anticipate 12 snowstorms that came through in the first quarter and how bad that was going to be. So like this year, got the snow shovel ready. We just had one out. I live outside of New York. We just had one come up the East Coast. But compared to last year, it was like nothing. So that was the main reason that that forecast didn't work out. Private sector job growth, this has been very good. We have a very healthy labor market with the private sector. One of our issues has been, and this just depends on your point of view politically, but we have actually lost almost 1 million state and local and post office jobs since 2009. It's very unusual in an economic expansion for governments to make that kind of cutback. But if you think about it, state and local governments, which is where the bulk of these jobs were lost, they are highly dependent on property taxes. And when the housing boom occurred, property taxes were rolling in, and of course they spent the money, and you can see that in the increase in jobs. And then when the recession hit, house prices fell 40–50%, property tax revenue went down, and these state and local governments had to make cutbacks. So that was a very big drag on the U.S. labor market. And my thesis is that quantitative easing was never going to create one new job in Illinois, Birmingham, Detroit. Wasn't going to happen. So I don't really think quantitative easing helped all that much, but it didn't hurt. So we have a very healthy labor market. The other thing that's happened is on the federal side, we have almost a balanced budget. Now, it's not quite. It's going to be about 2.5% of GDP deficit this fiscal year, and then maybe a small deficit next year. And we could, some people say, we could even have a small surplus in fiscal year 2017. The budget office says no, that the progress is over. But their forecasting track record is not good. So don't worry about them. But anyway, what happened is we have gridlock in Washington, and so we don't spend any more money, but the economy is growing, so tax revenues are growing every year. So we've really eliminated that. And I think that financial stability is a pretty good thing for the economy. So state and local governments are in better financial shape. The federal government's in better financial shape. We're just looking better. This is the unemployment rate. We're, at 5.6%, very healthy. Our labor force participation, the Fed worries about this. Not as many people are participating in the labor force. It really hasn't moved all that much, and it's peaked in 2000. This is not a 2008 recession problem. The labor force participation rates really took off in the 60s and 70s as women came into the workforce in much bigger numbers. And what's happening more recently in the last 15 years, as the population has aged, people have dropped out of the labor force a little earlier. We have a much better disability pension system that's taken a few people out. But none of these are reasons that the Federal Reserve can do anything about. So I don't worry about labor force participation. I just worry if we're creating jobs. Another thing the Fed worries about is hourly wage growth. The red line is core inflation. The black line is hourly wage growth. I don't know if you can do any pattern recognition, statistical math in your head, but there's no correlation there. Okay, they are not related. Now, if you do a little bit of a time lag, there is a little bit of a pattern. If you go into an economic expansion, about the 4th, 5th, 6th year of an economic expansion, you'll start to see a little more hourly wage growth. Then, if a recession hits, then it goes away. And then it's stable at low levels and then comes back. So there is a relationship between the economy and hourly wage growth, but not much between inflation and hourly wage growth. The Fed would like to see more hourly wage growth. I personally would like to see more wage growth too, so I'm with them. But we'll see how it works. We are creating jobs, and people are working a few more hours. So there's no question that there's more labor income, but not as much as coming from wage growth as the Fed would like to see. But all the other labor indicators are very strong. So if the Fed was only looking at labor markets, it would have already tightened up. However, this is the core inflation rate. You might note that from the middle of this chart, which is 1994, the core inflation rate's been between 1 and 2. We have gone through a tech boom and a tech bust, a housing boom and a really spectacular bust. Now we've had 5 years of economic expansion, and the inflation rate is between 1 and 2 the whole 20-some-odd years. The link between the Fed policy and the stock market and things like that and inflation ended with the S&L crisis. And that's not really an accident. In the last 25 years, we've put more regulations on banks. We have more capital ratio requirements. Banks have a lot better financial risk management than they used to have. So if the Federal Reserve buys a treasury bond or pushes rates one way or another, banks don't lend any more or less than they were going to anyway. So you don't get an unusual credit boom like you used to, and you don't get the inflation. So, you know, the only issue on inflation for the U.S. is it going to drop down a little lower? And the strong dollar does suggest that inflation is going to be drifting down. So we're below the Fed's targets. So what's the Fed going to do? Well, this is the Fed's assets, and it's flattened out. You know, it's not going to grow anymore. They're done with quantitative easing. But what are they going to do on rates? They told us today that they're still thinking about raising rates eventually. And apparently that means June to December, somewhere in that framework. But it doesn't mean March, April. So they're going to wait and look at the data. Why would they raise rates? Basically, this is a chart. The black line is the federal funds rate. The red line is the core inflation rate. It's highly unusual to have the Fed funds rate underneath the core inflation rate. There have been a couple of periods where the Fed has brought the short-term rates down equal to the core inflation rate, and that was during recessions like the S&L recession or that. But to have it below the core inflation rate and to keep it there for 5 years is a very unusual, extreme emergency policy stance. So my best guess is that there'll be a consensus on the Fed in the second half of the year, possibly as early as June, maybe a meeting or two later, that the Fed simply wants to get rid of the negative spread there between the Fed funds and the core inflation rate. So let's say the core inflation rate drifts down to 1%, and the Fed would want to get the Fed funds rate to about 1%. That's all. And then they would stop. That's what I think they're going to do. I think they're going to do it in the second half. I'm still on record as thinking they're going to do it in June. This ECB move gave me a little pause because it was a bigger program than I thought. It's going to push the euro, possibly push the euro down. Pushing the euro down with the yen weak pushes our inflation rate a little lower. The Fed might decide to wait and see. But that's my view on the Fed. One last comment and ending is equity markets. When you have this low of inflation, it's exceedingly hard for the average company to grow earnings. Top line revenues don't grow that much faster than the inflation rate. And the inflation rate's pretty low, 1.5%. So earnings growth, you're looking at 4, 5, 6% earnings growth for the average. And that's well below what it's been the last couple of years. So I think the stock market's going to struggle with a lot more volatility as it absorbs lower earnings growth. But I think there's some real positives from, like, the oil price decline is a positive for the economy. But in the short run, if you're an energy company, it's not so good. If you're a driller, it's not so good. You're not going to do some capital investment that you were planning on doing. So the stock market has got to take those blows and readjust its earnings forecast downward before it can grow again. But at least the earnings growth is positive. So I will stop there. I've covered a lot of markets. I'll be happy to take any questions. Go anywhere you would like to go. Yes?
Following on your last comment, what if the energy contribution is GDP? So if those guys are hurt, how exactly hurt is GDP?
It's like 6-7%. Yeah, 6-7%. It's not that terrible, unless, of course, you're in North Dakota or Texas. And then their GDP is way more related. But the basic part of the country is pretty, you know, it's not that big a contribution. What generally happens, though, is it's really a consumer confidence impact. Oil prices go down, gasoline at the pump goes down. A couple of months later, you realize you got more money in your pocket, and maybe you spend a little bit. So it moves from required spending to discretionary spending, so you feel better. But the total amount you actually spend doesn't go up much, you know, because you're taking it out of my gas pump money. So the actual positive on the economy is pretty small, but it is a positive for consumer confidence. The stock market has to deal right away with the fact that some people are not in good shape that they thought were. And so you get a lot of turmoil in the stock market right away, which is what's going on. Yes?
How does the European Central Bank derive its
If you owned some Spanish bonds and you wanted to sell them to the European Central Bank, they would create an account for you, and they would buy your bonds by simply writing in, here's €1,000,000, give me your bonds. And they just electronically create your account and your money, which is the same thing the Fed does. And when the Fed does that, they create Fed funds. So that's how central banks don't actually print more euros, but they do add to your account. In this kind of case, though, what they're going to do is they're going to lend euros to the Bank of France, the Bank of Spain, and they're just going to write it into those central bank accounts. You now have more euros. When you're a central bank, you can really do some amazing things. You know, we went through a long period of time in this country without a central bank. You know, Andrew Jackson killed it back in, I guess, 1840 or something, and we didn't recreate it till 1913. So you can live without a central bank, but once you have one, they can do some, you know, they can create money. Yes?
The Russian economy is dependent on energy. What kind of impact do you think that could have either politically or economically?
Yeah, I skipped through my Russian slide, but you know, they get a little more than half their revenues. Their government revenues come from the energy sector. They're like a huge amount of their exports, like 60, 70%. I mean, they are basically an oil syndicate. Okay? And so the price of their main product has been cut in half. It's not good. So they're going to have a recession. And that's before you factor in sanctions or anything else. They're going to have a recession. Future sanctions, by the way, got slightly complicated by the Greek election. This is a weird segue to your question, but the party that won is actually pro-Russian. You know, and for the European Union to put sanctions in place, they actually have to be unanimous, and they're not going to be unanimous anymore. So it's not clear that they can actually tighten up the sanctions, unless, of course, they were to buy the Greeks off by giving them more money. Might be a little trade going on here. Anyway, Russia's in trouble, Venezuela's in trouble, Nigeria's in trouble, Libya's in trouble, Iraq's in trouble, Iran's in trouble, Norway's in trouble. None of these economies are big enough to make much of a difference in the old global thing. So the net positive of lower oil prices far outweighs the issues that these concentrated countries have. Canada, the Canadian dollar has weakened, so you know they're in a little bit of trouble, not a lot. But so those are some of the impacts from oil. But yeah.
Those are all large oil exports, or oil exports you just mentioned.
Yes.
They also have extreme concentration risk in the energy sector. What countries are the exact opposite of that? Meaning that they're big countries with mostly import their energy, because that should help their stock market.
Japan has like, I mean, you know, they haven't found anything there. And I'm sure they've looked pretty well. Actually, they have, but it's in some water that's contested off China, so or off Japan. I'm sorry, I want to be neutral here. But so they're a big beneficiary of this. But it'll take their inflation rate the direction they don't want to go. But it's great for their economy to have cheaper energy. Many of the European countries don't have any energy resources of their own. So, you know, Norway and the UK are an exception. But North Sea oil is a declining production. It's been declining for over a decade. One of the things about the lower price of oil is if you're an oil company, you can't really shut down your wells if they're producing, because you need the cash flow to pay your debts and things like that. So you're not going to shut down a producing well, but you're not going to make the new capital investment. And the other thing you're not going to do is you're not going to maintain things quite as well, because that's a big capital spend on maintenance. And what happens is when you don't maintain things as well, a producing well's output falls off faster. And that's what's going to happen in the North Sea. It's going to decline even faster, because let me tell you, they have a real big maintenance budget there. That place is the North. I don't know, have you ever been to Aberdeen? What they say when you're in Aberdeen in Scotland is that we have 9 months of winter and 3 months of bad weather. But it is really, really cold. The waves are high. Out here is that high-cost maintenance areas will also decline faster. So they're hurt. You know, some countries, Eric, you did some things on this, but I guess Brazil is positively affected. Mexico's only a small negative. Chile is not in good shape, but that's not oil, that's copper. So, you know.
Why don't you choose Eric?
Yes. Huh? Yes, Eric Norlin is our, just joined us a couple hours ago on, January 4th, I guess, 5th. To help us out on the economics. So Eric will no doubt be back here telling his jokes. Eric and I have worked together in the past, but we haven't made presentations together in a long time, so there'll be different jokes at least for a while. But the charts will probably be the same. Yes?
Regarding Fed policy, I just got to think that with the rest of the country's currencies cheapening compared to the U.S. dollar, that has got to come into the Fed play when they're making their decision making.
You would think so, and you might be right, but I'm not betting on you. The question is, you know, if all these countries are weakening their currency, why doesn't that affect our policy decision? The United States has a long-standing tradition at the Federal Reserve of what we call, in the Fed-watching community, benign neglect. They almost could care less about what our policies do to the rest of the world, and they don't factor in the rest of the world's policies that much on us. There's only one member of the Federal Reserve Board, that's Stanley Fischer, that's a bona fide card-carrying global international economist, person that really understands global markets. The rest of them are very domestically focused. So if the weaker yen and the weaker euro and things like that actually start showing up in our domestic data, then they'll take it seriously. But until then, like if you read that Fed statement today, you wouldn't have known anything was going on in the rest of the world. It was like, we don't care. So you're probably right that they'll consider it at some point, but it hasn't gotten bad enough for them to put it in their statement and to think seriously about it yet. I think it's a huge flaw in the construction of the Fed that we're not more global and internationally concerned, but that's just the way the makeup of the Fed, the history of the Fed. If you know, and what central bankers will tell you is, hey, we're making policy for the United States. You know, if it impacts some other country negatively, that's tough. And then, you know, and the Europeans and Japan also think we got to do what's right for Japan. We got to do what's right for Europe. And if there's some implications for the U.S., so be it. But if I were there, I would be raising the international issues. But there's no chance of that. Yeah.
If and when they start to raise rates in the latter half of 15 years, do you suspect they'll do a measured rate hike campaign, like 04 to 06, or will it be like a one and done kind of?
Yellen has telegraphed that it's one and done or two and done. There is a general dissatisfaction in the historical analysis of Greenspan's 17-step program to, you know, that it just really wasn't the right thing to do. He took too many steps, but they didn't like the steps. So I think the 25 basis point incremental step thing is probably not the way to go. Which, by the way, means that if you are good enough to get the timing right and you're in the Fed funds futures, you're going to get a bigger payoff if it comes with a bigger step. Should I take?
You're thinking that Yellen may do a 0.5 step?
Yes, that's exactly what I'm thinking. And the way it gets a little messy here, we now have $2 trillion of excess reserves, meaning Fed funds that nobody really needs to meet reserve requirements. And so the Fed funds market doesn't function as easily as it did in the past when it was much smaller. So if the Fed wants to come in and do, they used to do like $5 or $10 billion of repos and move the market. Now $5 or $10 billion is a drop in the bucket of this $2 trillion. So it's not, you know, they're either going to have to do massive repo operations or they're going to raise the interest rate they pay on excess reserves, which is currently 25 basis points. So they'll probably raise that in one go to, like, say, 75, which will take Fed funds to about 55 or 60. And then they'll wait and see and then do it one more time and be done. So two and done is my current view.
When you say two and done, you mean 50 and done, not quarter done.
50 and then 50. I'm thinking they're going to get to 1% during the first half of 2016 in two steps. That's, you know, that would be my base case. And where I could be wrong is this global something bad happens in the global economy and that'll just scare them to death. I mean, when I say something bad, I mean a recession. That there's enough, you know, China implodes, they get really scared about the impact on our economy and they just wait. And the alternative to the upside is I'm wrong on the inflation forecast and we actually see more of it. I'm not going to be wrong there. I'm going to be wrong on the global stuff.
Do you think the PCE at 1.5 is that a big source of the trepidation not to move?
1.5 is no problem for them. 1's no problem for them. 0.5 is a big problem. If they really thought that the core inflation rate was getting below 1%, then they might delay. But if they stay within this 1 to 1.5, I think they'll just look through it. These are really small numbers we're talking about. I mean, 1%, 1.5, and I mean, moving the interest rate from 0 to 1, nobody's going to really care in terms of the economy. It's a positive signal because it says the Fed's confident in the growth of the economy, but from a financial standpoint, it's not going to make much deal for the economy. But it will be a very different kind of decision post-quantitative easing. When you've got a balance sheet that big, you can't do things the way you did them before 2008. So it'll have some nuances. Last question, and then I think we can have a glass of wine or something. Yes.
Let's just suppose somehow in the next 18 months we do go into a recession. I know no one's thinking that could happen, but if we do, what do you think the Fed will do to work with that? What kind of tools or measures does it have?
You know, you watch all these Western movies when I was a kid, and everybody counted how many bullets was in the gun. Fed's gun is empty. Basically, Milton Friedman was arguing that if you really want to get things going, you drop money from helicopters. And I'm pretty sure that will work. That will get people excited. There'll be riots. People will spend the money. That'll work. But if the Fed buys government bonds and the government doesn't spend the money, it doesn't make much difference in my scheme of things. If the Fed drops interest rates from 0 to 0, I don't think there's going to be any impact. By the way, if they put negative interest rates like the Swiss and the ECB did, that's not a stimulative thing. That's a tax on the banking system, that some of which will be passed through. Negative interest rates is not stimulatory. It's a tax. So that's an own goal if they want to go that way. So that they really don't have much to do unless they want to buy something different with that balance sheet. If they need to spend money that will actually get spent in the economy. And currently central banks do not do that because they buy government bonds, and the government bonds don't impact fiscal policy. So there's no direct link. The last time we had this kind of quantitative easing was the Reichsbank in the 1920s, and they spent the money. The government would print it and the government would spend it. I mean, like instantly. And then you got hyperinflation, but that's not what's going on now. We have fiscal austerity, and we have 0 rates, and we have quantitative easing, but there's no connection between the monetary and fiscal policy. Till that comes back, nothing much, So the Fed doesn't have a lot it can do. So if we do get into a bad recession again, you're going to be looking to Congress to spend, to put a spending program in place or cut taxes. And in these kind of situations, spending is faster than tax cutting if you want to stimulate the economy, which is what we did in 2009. I mean, the last thing President Bush did is sign $1 trillion of emergency spending. The first thing Obama did was spend it, and that's what 2009 was about. And that, it really helped, along with what the Fed did, get us out of things. Okay. Thank you very much. This is always fun to come over here. Great question, so thanks so much.